Well, the market's dealing with various cross currents. We've got geopolitics very much in the mix. We've got inflation concerns resurfacing. We've got US growth, which is ripping at the moment, despite a Fed funds rate being at 5.33% for a period of time. And talk at the moment is, why should the Fed cut rates at all? We've got OPEX coming up on Friday, and we're seeing various flows mixing things up. And people are asking, could this be the start of a 10% drawdown in the S&P, something we haven't seen since October? We've got the US dollar, which has been ripping, but is this the time to take profits? And we've got the Bitcoin halving in a couple of days' time. We discuss, could this be a volatility event and what will save price in the short term? This is the trade-off. Well, hi there, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to bring Blake Morrow from Forex Analytics into the program in a second. We will be discussing all the factors that are going on in this crazy, crazy world of financial markets, the cross currents that we'll be dealing with, the fundamentals, the technicals, and some of the trading views that we have on our radar. Mr. Blake Morrow, come into the program, if you will. A lot going on at the moment. I talked about the different cross currents. Price is king. We always trade. That's what we make our money from. That's what we lose our money from. That's what we have to risk or navigate the risks around. How are you seeing the world right now? Are you confused? Are you? Is this a good sort of hunting ground for you? How's the sort of markets treating you?
Well, I would say it's a good hunting ground. I'm going to be the first one to tell you I'm really happy that we haven't seen some sort of blow off top in the market. I was a little scared about that. Not because I wouldn't want to trade it. It's just more of I think I've explained my opinion here about generational highs if we did some sort of blow off top. But now we're seeing some two-way price action, and I like it. I mean, as a trader, volatility, that's what we love. And it looks like we can get more two-way price action. And I think there's a lot of, as you pointed out, a lot of cross currents that we have to deal with, which is a great thing, Chris. Bring it on. I mean,
bring it on.
We
bring it on.
Volatility, right? We talked about this last week.
Do you know, nothing, it doesn't always have to make sense, right? I mean, you've seen a situation with the equity markets been going up, with real rates going up, the US dollar's been rallying, oil's been, and then people say, oh, if oil keeps going up, then the equity market's going to fall. Well, now we're seeing oil prices falling, real rates are falling, the US dollar's falling, and the equity market's falling as well. These things wouldn't have made sense a week ago or so. So this is why we trade price. This is why we have to have an open mind, because it doesn't always have to make sense. What goes on in the flow behind the surface, is really important for short-term trading, which is why we are dynamic and react to price action, right? I think that's
100% agree. And a lot of times when price starts moving, if you can't find a reason why, it doesn't mean you don't have to trade it. It just, for me, maybe I have a little bit less confidence. That means I put a little bit smaller position on. Because price is driving the market. That's what I'm exactly following.
And everyone tries to understand the why. Sometimes the why doesn't really matter, when you're trading markets. Anyway, let's go into the why. On that note, let's have a look at topical thunder and see what's going on in the world. Right, let's bring up the US equity markets, because what we've seen now is a near 5% drawdown in the S&P. It has been, so semis are looking pretty ropey at the moment. Tech's been under a bit of pressure. Utilities are outperforming. Market internals are looking pretty poor. We've got about 30% of companies above their 50-day moving average. 56% of companies now at 4-week lows in the S&P. Technicals are breaking down. We'll look in a second. How are you seeing the near-term direction of travel for the Nasdaq, the S&P? We've got big earnings reports coming next week as well. Where's your trading bias?
Well, it's obviously down. And I say down because we finally got confirmation this week that the Nasdaq broke down. And, it's not surprising. We talked a lot about the Russell 2000 would be the big underperformer. It is. S&P looks ugly. And the Dow's already been breaking down. So finally the Nasdaq joined the party. And it seems like even like some of the indexes that really blew my mind, like the German DAX. I mean, the German DAX is holding on by the skin of its chinny chin chin right now before that rolls over. So there's, all these markets are pulling back. I think there's reason because of the overbought nature of the markets. And, we do get that seasonality that comes in. The sell in May go away. It might be sell in April this year, then go away. So I'm still focused more on the downside at this point, but I like selling rallies, and I like bounces in risk near current levels. I think the dollar might be showing us the way here.
I think you're right, and I think selling rally seems to be placed. I mean, it's trading below a 5-day exponential moving average, which is trading down. We broke through the 50-day. We've seen a lot of the CTAs have had to sell out from what we call a max length position, so that flow's taking place. The next sort of big sell level for these systematic players is much lower than where it is at the moment. But I think, weakness typically breeds weakness in this situation. And especially with the VIX at 18-19%, I think that tells you a lot as well. Actually, I think the VIX is probably a little bit high compared to where realised volatility is. But we do get a significant amount of earnings next week. Tesla, stock looks pretty poor at the moment. So, I mean, shorts are probably wise. But certainly IBM come out next week. We've got Microsoft, Alphabet, there's some big names. 42% or 40% of the market cap comes out next week, so that will be a potential driver. But for me, given the way that the flows are going, the technicals are breaking down, I do feel like the path for least resistance in the short term is lower. That's the way that I'm seeing things at the moment in certainly in the high risk equity markets.
And I don't disagree with that. And that's why we're going to be using these trends to identify different levels to trade, and hopefully we get a bounce to sell into. And that takes us into our next topic, which is going to be the PCE. And it's interesting listening to Powell's speech last week, 2 days ago, or yesterday for me, 2 days ago for you. I have to keep it all straight, and it's late in the day for me. But we were originally, and we have been focused on jobs, and I think that's where the focus of the market has been. But in his fireside chat this week, just yesterday, he was talking about labor markets are moving into a better balance, despite ongoing strength. He also really started to talk about the recent data shows in his words, lack of further progress on inflation, And the key takeaway was when he said it's appropriate to let policy take further time to work. And so that squarely really put the markets into, oh crap, inflation has been strong. We really need to focus on this. And the Fed's really focused on this, and it isn't really coming off. We're seeing that sticky inflation, if you will, which means that we really have to turn our attention to the PCE going. I can't even believe it's already coming up this next week. So, Chris, how did you read Powell yesterday in his in some of the comments he said?
Yeah, he's just another member who's moving into sort of the patient camp. They haven't got the progress that they would like to have seen. And I think the rates pricing is showing this now. We've got the first full 25 basis point cut being priced in for the September meeting. It seems odd to think that the Fed were going to cut rates in September. I know they like to say they're different, distance themselves from politics, but the Fed have never cut rates the month before a presidential election. So, it feels like if they're not going to cut rates in July, then they're not going to cut rates till the end of the year, if not at 2025, in my opinion. But that's where we are. So the market's saying, well, we're in a very much a patient stance, and everything in the US economy is saying, there's just no reason to cut rates at the moment. The Fed are desperate to cut rates. I think they really want to be in a position to do so, but the data's not there. We're averaging 280,000 a month on payrolls. Inflation's had 3 upside surprises. Growth's running about 2.8% on the nowcast models. Why? He's not seeing there in the data, and the dollar's been one of the major reasons why the dollar has been rallying. Well, we've got the exceptionalism story. Rate cuts have been priced down. We've seen US real rates moving up as a result. So I didn't really learn anything more from Powell other than that. I would imagine he would probably in that last March FOMC being one of the people calling for 3 rate cuts. He's probably in the 2 rate cut camp now. Would you say? Just a quick one.
I would agree with that.
There you go. Anyway, good little segue into the US dollar, because, you and I have both been pretty active in the US dollar. I think last week we were basically calling for the US dollar to scream higher. It's been a good trend to be in the US dollar. We've seen dollar yen trade up to 155. I'm a bit frustrated by dollar Swiss. I'd like to have seen a bit more. Didn't happen. Euro dollar, it pulled back to sort of 106. It's had a bit of a snapback as some of the funding currencies have done a bit better. Aussie dollar's been under pressure. Cable broke down. It's had a bit of retracement. But the US dollar's been a shining light. But we have seen a little bit of heat coming out in the last 12 hours or so. are we buying this dip now, this very small dip in the US dollar based on all the dynamics that we like about the US dollar, or are we just waiting a little bit more just for some of the the length to come out the dollar?
Well, Chris, I've got play of the day and setups coming. Why do you have to do that to me? I don't even understand why you just like roll over me like that.
Because I got in first, mate. First mover's advantage.
All right. Well, here's the way I'm going to put it. I think the easy trade in the dollar is over. And you're right. You and I have been very, very constructive on the dollar. I hate to do the pat on the back, we nailed it type of thing. But look, the broad-based dollar move. From here, it's going to be a little trickier. At one size does not fit all feet in the dollar is moving forward. So you're going to have to be very selective. Like you mentioned, the dollar Swiss. Why is the dollar Swiss not performing the way it should be? Which I agree it should be. But then again, with the risks associated around the Middle East and what Iran might do or what Israel might do next, that's keeping the Swiss franc fairly bid at current levels after it's slumped so much. So, and then you could even talk about, the yen, which we're going to talk about here in just 1 second. So there's a lot of different ways to play the dollar, I think, moving forward. But generally speaking, I think we need to be dollar bulls, generally speaking.
So if we're playing the dollar bull in an environment of still rising geopolitical considerations, especially when we go into weekend, people want to cover that risk. We're playing the US dollar against the high carry currencies, the LATAM currencies, the MEX, Brazil, maybe against the Aussie and Kiwi, but we're staying away from other sort of anti-cyclical low-risk currencies like the euro, yen, and Swiss franc.
I think so, and I think they're going to provide great opportunities in the weeks and months ahead too, just to be long some of those currencies. But that's not the topic that we're going to cover next. Next, we're going to talk about the yen. Our favorite topic, your favorite topic, and mine. Chris, we had the dollar yen finally break 152. Everybody's looking for the yen intervention. However, we've had a bit of a problem. We've had Prime Minister here visiting in the U.S. Right now, there's a G20 meeting. I think that the BOJ and Ministry of Finance officials are going to be a little hesitant, considering that at the G7 they really didn't want to. They don't want to upset the apple cart. So we might actually have to wait for a little bit longer for the dollar yen and maybe this yen intervention if we're going to get it. And my question to you is going to be, and you can answer in 1 second, are we going to get it? But here's one thing I want to talk from a tactical point of view when you're trading. If the BOJ knows, or excuse me, the Ministry of Finance or the BOJ knows that they are going to be intervening, let's just say next week after the they travel back to Japan from the US after the G20 meetings, that doesn't mean that they can't be selling dollar yen at 155 and maintaining an offer there or a bid in the yen, and then they let the dogs out, and then obviously they're going to make a crap ton of money on an intervention effort if they're right now filling their boots. So what are your thoughts about yen intervention in the coming days and weeks ahead?
Well, they're still making the same noises that we've been hearing for a long time, so it doesn't feel like we're in that period. We thought they'd be 155 was that real line in the sand. We've pretty much hit that. We've come back a little bit, but that point where we get headlines that the Bank of Japan are checking rates is your big key, and we haven't got to that point at the moment. But yeah, look, I think 155 was supposedly the line in the sand. It's not necessarily about levels; it's about the rate of change that they're always more concerned about. But it's difficult to see what's going to cause a significant reversal in the trend. I don't know. I think if we were to see the rate of change pick up once again and we broke 155, then I think we are definitely getting to that point where yen shorts are going to be feeling a little bit uncomfortable and be looking at hedging strategies for sure.
Well, let's not forget we do have the BOJ next week too that could spice some things up too.
Could spice things up. I also think you've got to look at China as well. I mean, I think for the dollars out there that China have allowed their currency to be not pegged, but working concurrently with the US dollar. As the dollar's got stronger, the yuan's got stronger on a trade-weighted basis. Not good for an economy which has got very low inflation to have a really strong currency on a trade-weighted basis. it means that we could see a gradual depreciation of the yuan, which I think has big implications for the US dollar more broadly as well. You've got a cheeky wry smile on your face. You want to say something, but we're not going to let you, Blake. Oh, go on. What's on your mind? What's on your mind?
Let's move on.
Let's move on. I think we're going to see something in that. Well, let's go to That's a Setup. All right, first one, Bitcoin. Let's bring it on. We've got halving coming up in a couple of days. I don't think it's obviously not going to be a volatility event. It's not going to affect the amount of coins in circulation. It's going to affect the primary market, the mining community. It's going to obviously halve the amount of rewards they're getting. Some of the sort of higher cost producers are going to go out of business because it's just not as profitable to do so. There's going to be consolidation, and I think over time some of the miners who the big miners will win market share. There'll be fewer miners effectively picking up more coins. But from a tactical perspective, like trading perspective, if I overlap the chart of Bitcoin, Blake, against the Nasdaq, it's working pretty much concurrently. So it's not a store of value. It's just a high beta risk asset, should we say? We've got price coming down into 6,100, 61,000 into that sort of support level that you can see. For me, it's just another play on the Nasdaq in the short term. Longer term, I think the halving will have big implications. If you're looking at a stock to flow sort of perspective. But how are you playing this right now tactically?
It's interesting, Chris. I actually just did a Bitcoin YouTube short, and I was referencing this exact chart. But I'm just going to say this: I'm going to turn neutral to bearish if we break below that support zone. And here's the reason why. You saw the way it reacted over the weekend during the Iran-Israeli situation. We can just call it that. And it was definitely a risk-on, risk-off a barometer. We break below 59,000. I think it opens the door for a lot of downside because I'm looking at it as a bearish reversal and a false breakout above the previous all-time highs, just above 70,000. So I like it to the downside if we get a breakdown.
I agree, and I think if the Nasdaq goes down, I mean, right now the correlation's there. The halving is not going to just cause this volatility event. It's just not going to do it. It hasn't done before, and it won't do it. Over time, it has big implications. From supply-demand perspective, depending what happens with demand. But I think over time the halving will have big positive implications. But short term, the technicals are marrying up with what we're seeing in the Nasdaq. If the Nasdaq breaks down and Bitcoin breaks through those levels, I think that's going to offer a good shorting opportunity as well.
All right. Well, my first setup is going to be the dollar Mexican peso. It's taco time. It may not be Taco Wednesday, and it maybe not Taco Thursday for you, because usually we just celebrate Taco Tuesdays here in the United States. But you can see that we have broken to the upside. We've broken out of that channel. The descending channels had us really just kind of captured there for all of like the end of 2023, 2024. But you notice that red box, that's a false breakdown in the dollar mex. Now what we're seeing is we're seeing a rally above that channel and rally above the 50 DMA. The 200 DMA is going to be the big test. You can see all those arrows that point to the very, very key rejections around the 200 DMA, around that level. We get above that and then it's off to the races. However, buying dips is what I'm looking at. Buying dips towards the 50 DMA or the 38% retracement at 1676 to 1680. I'm already establishing a position. I already stuck my toe in the water. Chris, you should come in. The temperature is nice. I think you should check it out.
I'll check it out, mate. I'll check it out. But we just talked about it in the last segment, to be honest. And, as long as these headlines are very much in play about Israel and Iran and there's back and forth, and we see cross-asset volatility high and nervousness as a result of that, then these high beta currencies, high yielding currencies like the MEX, the Brazilian real, you go into your risk currencies like the Aussie and the Kiwi, they're going to be under pressure, right? People are going to be selling rallies in those currencies, despite a more hawkish turn from LATAM central banks recently. So I think absolutely. Obviously, from a humanitarian perspective, we obviously hope that those geopolitical issues, simmer down. There's no guarantee that's going to happen. And so I think, in that situation, we go into the weekend. Once again, we're going to be probably looking to hedge our weekend exposure. That probably means we're going to see an underperformance from the Mexican peso. Dollar Mex, I agree, buy it on weakness. Let's go into a US 500. Let's go into the S&P. We've talked about it at length, but let's have a look at the daily charts. We're breaking down. We've run through the 50% retracement of the recent rally we've been seeing. We've got the 61.8% retracement at 49.03. But look, we're through the 50-day, which has obviously been a trend filter. That we saw some technical selling, but liquidation. We're through some CTA levels, which is some of these systematic funds which have had to sell. High vol as well has resulted in volatility targeting funds coming down. So it's the flow show coming through. Look at the chart. It's making lower lows. It's making lower highs. It feels to me that selling rallies remains to be the case. That we talked about it earlier from a technical perspective. Yeah, I feel like the path of least resistance. I don't want to be bearish. I mean, I don't want to be bullish. It's just what we're seeing, Blake, in terms of the price action levels. For me, what are you seeing?
Well, if you go all the way to the bottom of your chart, which is correct me if I'm wrong, it's the October lows of 2023. We are at the 24% retracement here at the 5,000 mark. Below that, it opens up the 38% retracement, which is at 4,800, which based on your headline or your title, it says 10% drawdown in view. Taking us down about 4,800, just below 4,800 is
47.30 is the 10% level that I'm seeing.
Is 47 what?
47.30.
47.30. So if you get to a 38% retracement based on my calculations or my fibs that I have drawn from that very low of your chart, it takes us to 48.30, which is not technical analysis. It's kind of like horseshoes and hand grenades. Close enough works, and in this case, it work. So
just let me say this, but in the last 10% draw, I'm not saying we're going to get 10% drawdown. Whatever. Who knows? The markets will do what it does. It goes to where it wants to go, right? But in last year, we had it took 65 days between July and October to get a 10% drawdown. It was painful. It was gradual. And then we saw the Fed pivot and effectively the market went on that bull run that you've been seeing to all-time highs. Is this the chance now that we're going to get a decent liquidation in those positions and get that first 10% drawdown? I'll be a buyer at those levels tactically, but obviously price will be the thing that dictates that.
Well, I'm going to tell you what's going to help it along. Let's go to Amazon. And I don't know if you've ever spent any significant time in the jungle, but I've had jungle rot, and it's not fun. It's when your feet or your body is like soaking wet for days and days and days on end. And that's the way this chart looks to me. I know
I've never had jungle rot, mate. I've never had jungle.
You don't really want it,
or trench foot or anything like that. No.
Well, Amazon, what you see is we had an ascending wedge. Ascending wedges are my favorite reversal patterns. We have now closed today below the trend line, the ascending trend line. So what that does is it opens up a move below the 50 DMA. You can see the relative strength is starting to break down as well. More importantly, though, Chris, if you look all the way back, and I guess I got to get my, I got to go back in time on the Amazon. It's the June 2021 highs. Exact same price we rejected and reversed at. Now, I know a lot of you will say double top. No, it's just really big resistance. That 2021 high, we rejected it here. We're reversing, and it looks like Amazon might come under pressure. You throw in a couple of consumer confidence crappy numbers, and Amazon could really be in trouble. So, what are your thoughts here on Amazon? I
couldn't tell you much about what's. I'm going to do a preview for clients pretty soon on what's expected, the sort of expected moves and bits and pieces. But I mean, technically, purely, I mean, I like these reversal patterns as well. The bulls have really tried to push this higher. They're getting less of a say. There's fatigue. The sellers are now winning this over. It just needs to get a bit more momentum, So what you do is you get your rate of change on the trading view charts, whatever chart you're using. When that starts picking up, that's when you can add to shorts, layer into the iceberg or whatever you want to call it. But yeah, I think this is now the start of what could be a meaningful reversal. We don't know, but these reversals happen with these kind of formations. It's what you do with these formations that makes you the trader, right? So, but right now you've put it on people's radar. It feels like the path of least resistance is down. Maybe establish a small position in this, and when it starts building momentum, add to that position. I think that's probably the way. Then obviously trail your stop based on an ATR stop or a moving average stop or something systematic. I think in that kind of capacity. But good setup, and thanks for bringing that attention. I'm going to be looking at that in earnest. Anyway, let's go to play of the day. Well, I like equities to the downside in the short term. I could be wrong. Who knows? But one of the ways I want to do that right now is is just a long short pairs trade effectively, because we saw United Health, boring stock, no one really trades it, but they came out with some pretty good earnings recently. It's filled the gap. Does it push higher? But it's 10%, well, it's 8.5% of the US 30, the Dow essentially. And the Nasdaq, I know we've got a whole raft of different companies coming out next week, Microsoft, IBM, and they're all got big weightings on that market. Tesla on the broader market as well. It's expected to have a big move next week. But look at this. I mean, I think that if we were to see a drawdown, one way we could just obviously go short the Nasdaq and trail that, which is what we've been looking at. But the other way to do that is if you want to sort of sleep at night and have a sort of a lower beta strategy, is go short the Nasdaq, long the US 30, because the US 30 is a more defensive market. It has its biggest weighting, as I say, as a healthcare company, which reported pretty good earnings. So I think from that perspective, you are going to see short-term outperformance from the US 30, which is why I want to be short the Nasdaq, long the US 30 as a pair trade, just offset the relative performance of the two. We can obviously look at other trades around that on a sort of pure one-directional basis, a one delta basis, but I like this from a long short perspective. Obviously, if we do see a lot of risk coming back into the market, things can surprise us at any minute. Like, let's say Israel backs down and decides not to come back at Iran. There could be some good risk that comes back into the market. There's other factors, of course, but if we were to see, the VIX trade back down to say 15%, risk come back into the market, then the Nasdaq's going to outperform. And of course, I'll change my tune on this. But in these testing times, I do think this is a relative value trade, which I think can work quite well.
All right. Well, thanks, Chris, for that play of the day. And I'm going to take you over to the dollar index. Like I said, I don't think one size fits all here when you're talking about the dollar. But if you want to talk about the broad dollar index, we just completed a Gartley pattern. We've got dark cloud covered today, so that should bring a little bit more downside maybe over the next day or two, which might allow you to be a seller in the euro dollar above 107, which I think is a great opportunity. Let's face it, ECB is going to be cutting rates. Fed's probably not. You got to play into that while we've got it. At some point, the Fed will cut rates, and that's probably the point where we're going to start to see the dollar weaken. But as of right now, I'm going to fill my boots. I don't even know what fill my boots means. I learned this saying from you, Chris, but I know I'm going to load the boat, back up the truck, and fill my boots. So that's the way I'm looking to play the dollar. And just to make it a little bit more clear, I'm looking around the 105 to 105.50 level as opportunities to be on the long side. And I think we eventually take out 107 and trade up towards 109, which means the euro is probably going to get closer to 103, 102 before I really start looking to get long euros longer term. So
I think the thing with the euro for me is it's nothing to do with the cyclicals or what the ECB doing. For me, it's just because we've seen an unwind of the carry trade, and the euro's been a bit of a funder for that. I think some of these funding currencies have done a little bit better. So I think it's just positioning more than anything else, Blake. I mean, I think when we go back to the relative attractiveness of Europe versus the US always wins. Yield spreads, US wins. Central bank divergence, US wins. So right now, it's just probably just a bit of positioning unwind with the funders coming back in. So a bit of weakness in euro would probably just take us down, and that's where you can take your boots off and just load up your dollars, dollary doos, get in your boots.
Fill in my boots.
Fill in your boots. Anyway, thank you, Blake, for all your great thoughts. It's a lively show, and thank you everyone for sticking around. If you've enjoyed the show, we'd love you to smash the like button. Really appreciate that. Leave a couple of comments. Sorry we didn't get to anything in oil. I think oil's going lower personally, and sorry we didn't get into anything on gold. I know a lot of people love to trade gold, but next week we'll look to do that. And if you've got any thoughts on oil or gold, I know people do, then just leave it in the comments section, and we'll try and respond back to those and give us some of our thoughts, and just let us know how you're trading the financial markets. We'll see you back next week for more of the trade-off.